Good morning, everyone, and welcome to the June edition of our On Top of Tax webinar, where we cover the latest developments and upcoming deadlines across corporation tax, VAT, and employment taxes to keep you all up to date. My name's Claire Hudson. I'm a corporate tax partner based in our Midlands region, and I'll be covering the business tax content today. Other speakers are Chris Rowe and Amit Dev, who will be discussing tax technology, particularly with a VAT slant, and Karen Tura, who will be giving us an employment taxes update too. A little bit of housekeeping to start with. Firstly, just to let you know that we'll be taking a short break over the summer, and our next webinar will then be in September. And secondly, just to remind you all that you're welcome to use the Q&A function as we go along to enter any questions that you have, and then we will come back to those at the end of the session. So if we kick off then with corporate tax, first of all, just a brief reminder of some key upcoming deadlines from a corporation tax perspective. First of those being 30th of June. If you are a June year end, hopefully you'll be well aware that corporation tax returns are due by this date, along with your corporate interest restriction return, if you fall within those particular rules. June is also a deadline to watch out for from a senior accounting officer perspective. If you're a September year end, but not a PLC, June will be your deadline for submission of certification. And if you are a December year end and are a PLC, similarly, that will be your SAO notification and certification deadline. For those businesses who fall within the normal 9 months and 1 day payment deadline, then if you are a September year end, 1st of July is a key date for you. And 14th of July is also the quarterly submission deadline for the withholding tax form CT61 and to pay across any tax due on interest and royalties to HMRC. Similarly, it's a corporation tax instalment payment deadline date, obviously dependent on your year end and whether you are part of the very large or large payers regime. If we move along then to the very topical issue of the general election and key things that businesses might need to prepare for from a tax perspective, we're just going to take a very quick look at the parliamentary timeline first of all, kicking off with election day and running through to the autumn. Two key points really to take away from this slide. The first one is the 17th of July is quite an important date. So that's the state opening of Parliament. The King will obviously undertake his speech, and that will set out the legislative agenda for the forthcoming Parliament. So there may well be a few key tax snippets to listen out for there. The second point is that we are expecting that the 10-week notice period for the Office of Budget Responsibility reporting is going to remain in place, and therefore what that is very likely to mean is that we won't end up with a very quick emergency budget. Instead, the likelihood is that we'll end up with a budget, potentially an autumn statement, or equally could be a full budget at some time in the autumn, possibly late September or going into October. Next slide, please. Okay, so let's take a little bit of a closer look then at what the tax manifestos of the key parties are likely to entail, starting with business tax. So from a corporation tax perspective, both the Conservatives and Labour have confirmed that they're not expecting to change the headline corporation tax rate. And Labour specifically have said that they expect to maintain the rate at 25% for the next 5 years. The Lib Dems, on the other hand, have made clear that they would look to restore the bank surcharge and also increase the bank levy, whilst also announcing that they would bring in a 4% tax on share buybacks by FTSE 100 companies, which would be a new tax. From an oil and gas windfall tax perspective, Labour have made quite public that they would look to increase this by 3% and also extend the duration of that tax until the end of the next Parliament. The Lib Dems, on the other hand, have suggested that they would bring in a new one-off windfall tax on super profits. So from a VAT perspective, relatively quiet, with the exception of Labour's stated intention to apply VAT to public school fees, which has been much publicised in the press. And then looking to investment and growth, I think one key takeaway is that none of the key parties have really discussed significant changes to the capital allowances regime, to R&D or to patent box, suggesting that there might be a period of stability there. Labour have, though, declared that they will look to set out a corporation tax roadmap with the intention of bringing around growth, but also creating stability by making it clear from the outset what they intend to do with corporation tax. They're also suggesting that they will significantly reform our planning rules to boost house building with a particular focus on affordable homes. And they're also discussing a national wealth fund looking to create new jobs and rebuild and revamp certain sectors of the economy, including the steel industry. Lib Dems similarly looking to focus on productivity. They have stated intention to provide incentives to invest in training and for businesses to take up digital technologies. And then looking to the international arena, as expected, Tories have not suggested any changes in relation to Pillar 2. Labour have said the same and have specifically stated that they would not look to bring in a new digital services tax. Lib Dems, on the other hand, have suggested that they would actually triple our 2% digital services tax to 6% should they come in. Now, business tax, again, well talked about in the press. Labour have discussed replacing business rates altogether with a completely new tax. They're looking at really levelling the playing field between members of the online retail community and the high street. And the Lib Dems have similarly said that they would look to reform business rates altogether, but haven't at this stage really given us much detail about what that might entail. Moving on then to employment tax pledges. So across the board, no changes have been announced in respect of employers' national insurance. Labour and the Lib Dems have focused quite heavily on employment rights. So Labour would be looking to ban 0 hours contracts and also significantly transform the apprenticeship levy with a view to creating what they've described as a more flexible growth and skills levy, giving employers a bit more flexibility in how they apply that levy and put those funds to use. Lib Dems have similarly suggested they would replace the apprenticeship levy, but again, relatively light on details in terms of what they would look to do with that. All three key parties are looking to make some changes as regards immigration. The Tories have suggested that they would bring in an annual cap on migrant visas, and Labour have specifically stated that they would look to limit or ban hiring employees from overseas in cases where employers or agencies have previously breached employment law. Lib Dems are, on the other hand, looking to negotiate specific deals with overseas territories, focused on bringing in workers from particular sectors on a fast, low-cost basis. In terms of national minimum wage, the Tories have stated that they'll look to keep that set at 2/3 of median earnings. And Labour have publicly declared that they would look to create what they've called a genuine living wage, and that would be set at a single rate for all age brackets. Lib Dems have instead focused on carers in particular and would look to bring in a supplement to the national minimum wage in that arena. And they're also talking about a specific limit for 0 hours contract workers as well. And then moving on, just a brief look at personal tax pledges, which I'm sure will generate some interest for most of us. So no changes suggested by any parties to income tax rates. As we've seen in recent years, there is a bit of a reliance on fiscal drag as a revenue raiser, and all parties have suggested that, at least in the short term, income tax bands would be frozen. Tories and Labour stating that this would be the case until 2028, whereas the Lib Dems have said that they would look to unfreeze the bands as soon as funds would allow. A headline grabber from the Tories in terms of child benefit, they've specifically stated that they would look to increase the threshold at which child benefit begins to be clawed back to 120k from the current 60k, and that they would revamp the rules so that this would be based on joint rather than individual income. They've also set out intentions to bring in a pensioner allowance guarantee. I think the papers have coined this the triple lock plus, where they would look to increase both state pension and personal allowances for pensioners by the higher of 2% wage growth or inflation. From a national insurance perspective, the only change that's been alluded to was a very recent one suggested by the Tories, that they would again look to bring employees' NIC down by 2% when that's possible, so no specific timing there. And then from a CGT perspective, again, the main headline grabber here is from Labour. They're suggesting that they would look to close the private equity loophole for carried interest and take it out of the CGT regime and into the income tax regime, though they haven't actually been specific about the rate that they would apply there. The key headline from an inheritance tax perspective has come from Labour. They've suggested that they would look to bring offshore trusts within the scope of inheritance tax, part of the wider plan to crack down on non-dom non-compliance. And as expected, really, they've said that they would go forward with the suggested changes to the non-dom rules that the Tories announced at the previous budget, but they would take a harder line and look to close down loopholes and would not allow transitional provisions. And then from a property perspective, both Labour and the Tories have suggested that they wouldn't mess around with council tax bans. Lib Dems, on the other hand, have said that they would look to increase council tax on second homes. Next slide, please. So if we then go with what the polls are currently predicting, and assume that we'll have a Labour win, I think in summary, we'll be looking at some very specific tax rises. So in particular, closing the private equity carried interest loophole, bringing VAT on private school fees, certainly increasing the oil and gas levy, and potentially looking to make changes to the rules to reduce allowances for capital investment. Tougher reforms being suggested for non-doms than those currently proposed, and an income tax bands freeze to 2028. On the contrary, in terms of, I guess, beneficial improvements, they are looking at the removal of 0 hours contracts and increased employment rights, a complete reform of the business rates regime, along with significant changes to planning law. And they've also suggested that they would bring in 5,000 more staff to HMRC to crack down on anti-avoidance and look to reduce the tax gap. So a very brief run through there, but hopefully drawing out some of the key points to get businesses thinking about things that they might need to prepare for. Despite then Labour having suggested that they would bring in no significant changes to CGT or IHT from a shareholder perspective, we are inevitably starting to see lots more discussions around selling businesses, mainly whilst we have that certainty in the tax regime in the run up to the autumn. So a couple of key things to think about if you are considering selling your business. I think the key takeaway here is absolutely that early planning, preparation and advice is key if you are looking to maximise your after-tax return. Considerable thought needs to go into specifically what you would look to be selling. Is it a subsidiary? Is it the whole group? Is it simply the trades and assets or specific assets? What's the driver behind the sale? Are you looking to retire? What would you do with the proceeds? Would you be looking to reinvest in a new venture? Is the intention simply to pass on the business to the next generation of the family or potentially employees? And what do you need to do in terms of pre-sale restructuring to get the overall post-sale structure right? Is there a need to split out certain assets from the structure, potentially property? Do you need to think about bringing in family shareholders or putting shares in trust ahead of any sale as part of an overall plan to manage your tax liabilities arising on sale? And of course, processes tend to go a lot more smoothly if a business has a clean bill of health from a tax perspective. And so it may be worthwhile giving consideration to undertaking a vendor due diligence exercise so that any tax issues that are there can be highlighted and hopefully resolved in advance, so you don't end up in a position where the purchaser has leverage to eventually knock down the price. So just a few key points to think about there. Next slide, please. And then finally, I jump around in topics, I know, but just to round off this section with some key upcoming deadlines from an indirect taxes perspective. 7th of July, as you're hopefully aware, is a quarterly or monthly VAT return and payment deadline. And the 31st of July, albeit a few weeks out, is the deadline for quarterly CBAM, CSOP and plastic packaging tax returns, as well as a key payment deadline. So that's it from a business tax perspective. I'm going to hand over to Chris and Amit. Thank you.
Thanks, Claire. Hope everybody can hear me okay. So we're going to do a short session on tax technology. That's a real hot topic amongst our clients. We thought we could cover a session today. So you've got myself and Amit. Before we do it, introduce the team and kind of what we do more broadly. We want to start with a quick poll, which hopefully will appear on screen seamlessly. Yeah, so we've got two questions because we're going to focus around ERP implementations and automation. So quick question, I can see everyone's answering already, which is great. So yeah, are you going through an ERP implementation or just completed one? So yes, no, not sure. And then do you have access to Alteryx or Nime or other similar platforms, so automation tools in your business? Yes or no? We'll give everyone 30 more seconds to answer if that's all right. Everyone is answering rapidly, so much appreciated. We've got 80% of people have voted now, which is great. So in terms of the ERP implementations then, so 60% no, but 30% yes, so that, which is interesting, and 15% not sure if they're going through an ERP implementation or not. So we'll go through some hints and tips around ERP implementations later, and on automation, 11% have access to automation tools, 64% no, 25% yeah, alter what? They're not sure, which is fair enough. So yeah, so quite low on the automation. So hopefully after today, we'll give you a quick flavour. You might be intrigued to have a bit more of an explore on that one. Cool. I'm just going to stop sharing that. So thanks for that, everybody. So yeah, in terms of the quick opener then. So as I mentioned, so you've got myself and Amit from the team today. We sit in the Midlands, but we have a national remit on VAT, and we also in the North cover cross tax. So quite a wide remit. In terms of the band in the middle on this slide, that's kind of the core things that keeps us busy. So starting on the left, we've got tax technology strategy. So I think with technology, what we find is clients will say, yeah, really interested, but I'm not quite sure where to start. So we help clients to navigate that. Which can be quite complicated. Then we move on to systems reviews. So in the world of compliance and governance, this is kind of taking a look under the hood of the system and saying, does the system actually do what we think it's doing? Does it produce accurate tax accounting, or are controls sufficient? Implementations, as I say, Amit's going to cover a few slides on ERP implementations because we've seen a huge uptick I think, a backlog created since Brexit and COVID. So we'll go through some tips on that and the various stages. In terms of data mining or data analytics, so yeah, so I think this is, I guess, a trend in terms of big data, but from a tax perspective, what can you do with it? And you can achieve a lot if you can get to the data. And partly how you get to that data is then linked to automation as well. So automation is great for a number of things, as we'll come on to a bit more throughout this. But essentially, automation is looking at, we all have manual processes we need to do. Can you use an automation tool to automate that? And then once you're kind of familiar with those tools, could you then actually take data from various different sources and then be able to use data mining, for example? So you've got pulled data from various parts of the business, so therefore can give you better insights. And the bottom bit is a flavour of who we partner with, essentially. So BDO is agnostic. We don't have our own tools. What we do is work with all the different vendors that are out there, and this just shows there's a whole myriad of them, and navigating that complex world. So we go to the next slide, please. So we thought we'd start a small bit on horizon scanning, and I think the overall message really is that at the various different levels, so starting off with the OECD, this is so back at the end of 2020, December 2020, published a paper, and it's all around the digital transformation of tax administrations, and they're publishing various updates on the actions. So at an OECD level, we're getting pushed in that direction. And EU level, we've got VIDA as an example, so VAT in the digital age. And you'll be seeing, so I think the latest one in the news is Germany around rolling out e-invoicing. So they're formally introducing it from 2025, so from 1st of January. And various countries are at different parts in their journey around e-invoicing, but they're also looking at the platform economy, digital reporting, and also the concept of a single EU VAT return. And then, yeah, transformation of the in-house role. We're seeing this more and more, and Amit will give some more examples of what we're seeing. But it's about kind of embracing technology within industry as well, and therefore looking at things like training, for example, to train up maybe a member of your team that can actually be the champion for technology within your business, and helping dealing with the various things that are down the road, like VIDA and the OECD. If we go to the next slide, please. Going back to the point which Claire touched on in terms of the election, so under the Conservative government, some quite good things in terms of, so the UK scene as the #1 in Europe as a tech centre, and in terms of AI, we held the world's first AI safety summit, and probably back in the autumn statement, there was large pledges announced on technology, in particular AI and quantum. So it'll be interesting to see how technology plays a role in the election, and also what the new government does on that front. If we go to the next slide, please. So I'll now pass you on to Amit to take you through a whistle-stop tour around ERP implementations and what to look out for.
Thanks, Chris. Hopefully everyone can hear me, and good to have you all on this forum. So just a quick 30-second on this slide. It's not quite a deep dive, more of a kind of dip the toe in the water, so to speak. So in terms of a general ERP implementation, you'll come across these phases: kind of discovery, setting the specification, the design, configuration, especially from a tax perspective, UAT, user acceptance testing, and then go live or post go live, kind of hypercare support. Essentially, what we wanted to just bring out from this slide is we think from the implementations we've assisted with, it's really important that tax is at the table from the start. So from all the way from the discovery phase, all the way to post go live, kind of weeding out the issues. We think tax is very important to be there at every step of the way. If we go on to the next slide, please. Thank you. In terms of common pitfalls, so just to bring a few things out here. So we've assisted with a number of implementation over the years, and it's kind of the same themes that we see when an ERP implementation doesn't go well. One is, especially with this shift from on-premise solutions to cloud solutions, these type of ERP systems, name it Oracle Fusion, SAP S/4HANA, and so on, such as NetSuite and Dynamics, and there's others obviously available. We found that they tend to work best where the standard processes are adopted. So it means a proper transformation. So you need to start thinking about, is this going to be a lift and shift, as in my processes are perfect and therefore I'm just going to embed these in the new system? Or do you take a more holistic approach and take a step back and go through a proper transformation? We find that when you have too many customizations, which is usually paired with a lift and shift approach, with these cloud systems, they have regular quarterly updates, and when an update comes along at the quarter, these customizations start failing. So this is why this approach it is preferred for these systems. And then there's thinking about expectations. So managing your expectations. The system can do so much. It's rare that you're going to have full automation. And then user acceptance testing, especially from a tax perspective, is paramount. Making sure that you test the range of scenarios that you have in your business, to make sure that you are holding the system implementer to account in terms of how the requirements being met or not. We go on to the next slide, please. And this shift from on-premise, full customization, full automation, expectation to cloud, where you're going to get quite sufficient automation within the system, but there's going to be areas where really you don't want to automate in the system, especially from a tax perspective, because if a regime changes somewhere, even in the UK or somewhere globally, then that means a reconfiguration, which is quite lengthy sometimes, depending on what it is, and can be quite complex, and that means cost. So we recommend thinking about automating some sort of calculation for tax purposes outside the system. And at the heart of that, what we see over the years is these ETL type solutions. And when we say ETL, this means extract, transform, load. And the type of tools that play in this arena are Ultrix, Nime, Azure Data Factory, and so on. And as you can see, they form the backbone we're seeing in terms of automation, in terms of linking to your core accounting system, bringing that data out, and then adding calculations and so on, then feeding engines such as data analytics, tax compliance software, e-invoicing, which Chris mentioned earlier, as well as being the kind of filling the gap when it comes to systems implementations. And then now moving forwards in terms of artificial intelligence, a number of these platforms already have machine learning capability within them. So if we move on to the next slide, please. And that should be a good segue in terms of AI. So that's probably on everyone's agenda. Maybe you're not sure how to embrace, or maybe you're a bit skeptical of embracing artificial intelligence. But if we take a step back for a second and have a look at what we're seeing, just to bring a couple of points out from the right hand side. So probably the first step in terms of, one of our questions was, in terms of do you utilize Alteryx or Nime, and quite a few said no, and quite a few said alter what, as in what does that even mean? So it's probably good first step is to get to know and gain an awareness about what's out there. So the CIOT now has a formal training process for taxonology, and our team have fully trained up, or are in the process of being trained up on what they call DITT. So have a look at that. It's quite good as an awareness piece, and it's quite broad. And then there's training up on Alteryx and other types of platforms such as Microsoft Power Platform. And then there's looking at your tech stack. So before you even take your first step, it's probably worth doing a bit of planning in terms of what do I actually need, what's coming, doing a bit of horizon scanning, what's coming up in the next five years or so. Am I going to make those requirements given the current tech stack I have, or do I need to start investing in automation platforms, or is there an implementation going to happen within the next 2 years or so? So it's probably worth doing that. And then we've mentioned Alteryx and Nime automation platforms. They might be your first step to enabling you to utilize these next generation technologies such as artificial intelligence, because they have machine learning capabilities, but also you might have available for your Microsoft packages such as Copilot, which is paired with OpenAI, as you know, ChatGPT. So maybe that might be one of your very first steps as well, to start dabbling in that space. That's all we wanted to cover today. Hopefully that's been useful, and I'll hand you over to Karen. Thank you.
Thank you. Thanks, Amit. So hi, everyone. I'm Karen Tora, an Employment Taxes Director, and I'll be spending just a couple of minutes sharing an employment taxes update. So for those of you in the employment taxes space or involved in the employment taxes year-end reporting cycle, you'll know we have a busy couple of weeks ahead of us. The reporting deadline for reporting employment-related securities on the ERS online return and for benefits provided to employees on the forms P11D falls on the 6th of July, as well as termination payment reporting and former employee benefits reporting, if applicable to your workforce. So for many of us, this actually means we're completing these returns on the 5th of July, the Friday before being the last working day. And as has just been mentioned earlier, it's going to be a busy period for things more broader than tax. There is also the PSA agreement deadline on the 5th of July, which is the last date that you can update the 23-24 PSA contract with HMRC, which is used to agree line items to be added to the PSA. As a reminder, a PSA is an annual return where, as an employer, you agree to settle tax on benefits you provide to the employees, and you do this on a grossed up basis. So it can be slightly more expensive than usually providing benefits. This deadline is important as it agrees which type of expenses can be included for the subsequent PSA calculations, which are submitted by October this year. I wanted to spend a couple of minutes actually sharing some insights and issues that we are seeing clients face this year as we support them with this reporting. And I thought it'd be useful to flag these as I suggest you look out for them, given the additional costs, including the tax cost and the risks that it can potentially present. So next slide, please. So this year, more so than other years, we are seeing a significant increase in the provision of wellbeing related benefits to employees. But what they are and what they encapsulate can be inconsistent. And so I'll explain the challenge this presents a little later. But if we cast our minds back, during and immediately post-COVID, we did see an increase of certain types of benefits provided, such as support for working from home, primarily for things like office equipment, COVID vaccinations, potentially having the workforce travelling into the office in a safe manner, and utilising the smaller trivial benefits that could be provided to employees, such as providing vouchers to spend on wellbeing, gym equipment and so forth. Also during this time, there were specific tax reliefs issued by HMRC, which encapsulated some of what I've just spoken about, which meant that many of these were not considered taxable benefits, but most of these reliefs have actually come to an end. So post-COVID and now, there has been an introduction of new wellbeing and wider benefits to support employees. And whilst these are aimed undoubtedly to support employees, in reality, what we're finding is that if they're not classified correctly from a tax perspective from the outset, there may be an unknown or an increased tax cost associated with the provision of the benefit. That may present a knock-on impact when it comes to additional administration required, such as on the P11D or PSAs. The benefit may actually have no measurable positive impact on wellbeing, productivity and performance. And so in some extreme circumstances, what this is doing is creating a significant additional cost for employers in providing a benefit which has little or no benefit for the employee population. And then finally, there are increasing regulatory reporting requirements around benefit provision. Some of these are linked to ESG and new reporting there. as well as a focus on existing legislation such as national minimum wage and the living wage entitlement. So with continuing budgetary pressures for business, the impact of the inflationary pressures and increased cost of living, there is this desire that businesses want to support the well-being of the workforce and in a manner really that maximises the budgets available. Next slide, please. So what are we seeing the role of tax and finance teams, and where does that come in? Well, we're seeing it as practically to advise and influence on the interventions that may be considered by the broader business, and to highlight the total cost impact, which includes the tax reporting and withholding costs. So by helping to maximise the budgets available and focusing on the interventions that are seen to be working, this can really help support the business and the workforce. And research actually supports this, saying for every £1 that's invested well in wellbeing interventions, there's a £5 return for the business. Next slide, please. So how do we do this? It's probably the main question right now. As a starting point, the reward packages that we are seeing have evolved significantly in the past couple of years. There are many benefits available, and this has increased significantly as shown on this slide. There may be less opportunity to continue to increase base salaries, particularly because of the inflationary pressures, although we would have seen today that these are easing. But helping to identify valued benefits that attract a tax and or a NIC saving is a really good starting point. Also then supporting to effectively communicate the value of these benefits in an overall employee value proposition, or it's known as EVP, is a really strong proponent to attract and retain talent. Another thing to consider, and what we're seeing is that many organisations may be adding to their current benefits package, but may not necessarily be taking away. So thinking critically about whether the current benefits package you have is fit for purpose is vital. Do you have the correct data on knowing what your benefits cost, what the tax impact is, and whether it is valued by employees? The use of data is particularly useful here and may already be available, such as take-up rates, renewal costs, and engagement surveys that you take within the business. If we look to the sort of right-hand side, more recently we've seen that there's been a significant increase in financial well-being and mental well-being benefits, as well as some more physical related benefits focused on specific workforce populations, such as fertility and menopause related benefits. So I'd like to take this opportunity to do a quick polling question and just ask the audience if you have added or enhanced your benefits programme in the last 12 months, or if you intend to do so in the next 12 months, and if so, with what? So I think the poll is open now. Okay, so as we get to 150, what's really interesting here is, so as was mentioned, it seems as though mental health and well-being apps seem to be the most popular in terms of introduction, followed by financial well-being and other benefits. What's really interesting here actually is the comment on not sure. And again, this is probably because what we typically see is that it may be managed and led by a HR or reward function. But as I've mentioned, you know, the practicalities in terms of the additional costs and the additional regulatory and reporting requirements that may be borne from a tax perspective are really interesting to consider, and having that conversation with the broader stakeholders will be really important. So if we go to the next slide, please. And if we finish off with some of these practical things that can be considered and things that you can take back to your business, as I've mentioned, one of the first things to do would be to consider the benefits package as a whole and consider if the tax and NIC considerations of those provided are correct and up to date. Is there a tax cost to consider? And do the business know about it? Where the selection of benefits and wellbeing related expenditure is decentralized across the business, is there a way to understand and establish what that is? To then establish what this true cost is, considering if there is any related tax. So commonly there may be some benefits that are provided outside of the formal rewards package, such as we're seeing wellbeing prizes, some socials, things that may be related to benefits that may be reported elsewhere, such as on the PSA, for example. If the benefit is seen to be taxable, then is there the opportunity to provide it more efficiently to utilise available tax exemptions? And what we're seeing of particular interest at the moment is particularly trying to use the opportunity to review and re-engineer some benefit provisions. So as an example, I know that some of you had mentioned that you will be offering the services of an employee assistance programme. And an EAP is just one that can be used, and in considering what can be covered and not covered, may move it from being a taxable benefit to something that is tax efficient. So that's worth exploring. Another example can be seen with the change to the location of work or hybrid working for some organisations, where there may be the reimbursement or the cover of travel and related expenditure, which is creating some real complexity. So some organisations are choosing to bear travel costs, typically for a short period of time, to encourage employees to come back into the office or to embrace hybrid working and be in the office for a couple of days. Others may be covering cost where there is occasional overnight accommodation now being provided, where an employee now mainly works from home. But both of these instances can fall into the grey area of taxable travel and benefits, and possibly seen as ordinary commuting if not set up correctly. So again, considering this would be a good a thing to do. I think moving on, it's fair to say that medical insurance related premiums have seen an upward trending cost for most, if not all, employers. And we've seen that many employers have looked to switch providers as a way to control costs. A change in provider may lead to changes in process, enrolment, data collection and amendments. So again, in trying to make sure that your taxable value, benefit value is correct, it's really important to ensure elements such as proration, mid-year enrolments for joiners and leavers, and other considerations are taken in the round. And then finally, where we see a benefit being rolled out for those with an international footprint, and we've seen this particularly where there may have been apps provided, for example. Something that should be considered is that one size does not often fit all in the benefit space. So something that's seen as non-taxable and non-reportable in one country may not have the same assumed treatment in others. So again, this is worth a check. I'll finish again just to return to that statistic that an effective wellbeing benefit will have an ROI of £5 for every £1 invested. So the cost of your benefits and wellbeing programme is likely to be seen to be an increasing part of your overall budget, but taking time to consider what you are currently offering, how it can be improved, and how you can consider the related tax costs can be identified and mitigated will really help maximise the benefit for you and your employees. I'm now going to pass back to Claire, I think.
Thank you, Karen. Okay, we'll move to Q&A then. Just going to bring up the questions that have been raised so far. Okay, so first question here is for Chris and Amit on automation. If one or both of you wants to turn your videos back on. So the question is, automation sounds great in theory, but where do we start?
I'll take this. That's okay, Chris. So that's a great question. In terms of where to start, I would say it's about the strategy. So taking a step back and thinking about all the tax processes you have, how much of it is manual? Where are the pain points? Is really having that time investment, because it takes a bit of time to really think and challenge yourselves, as in, is there a better way of doing what I'm doing? That's really where it starts. And then when you find those pain points, usually it's in VAT, PSA, corporation tax, code analysis, those types of kind of heavy kind of data driven processes tend to be a good starting point. Hope that answers the question.
Thanks, Amit. Next couple of questions actually are on employment taxes. Karen, if you don't mind coming back on screen, please.
Here I am.
Thank you. Okay, so the first question is your slide on the evolution of benefits. Could you give a brief overview of which benefits from that slide should be included in a PSA if they're not included on a P11D? I'm not sure whether you can give us a comprehensive answer on that one, but maybe.
Yeah, I think, I mean, there's probably about 60 benefits that are listed on that slide. And the first thing I'd say is that is exactly the sort of exercise that you'd expect any organisation having to consider, really, because there's a couple of decisions that may need to be made. One is whether the business wants to be picking up the cost of the associated tax or not. That will have a consideration as to whether it's a P11D or a PSA benefit. Another thing is whether it falls into the criteria of meeting the definition of the sort of benefit that can fall under a PSA agreement, which is it minor in value, irregular, and impracticable to operate on the payroll. So again, given things like the amount of the cost and the type of benefit, it really depends on the business, I'm afraid. As I said, the ones particularly in the middle are the ones that are of the slide are the ones that have a particular opportunity or a known opportunity for tax and NIC savings, so they may not potentially be reported on either. But yes, that's something that is exactly what the whole exercise of reviewing the benefits is in regards to as a starting point.
Thanks, Karen. And another question for you, actually, while we still have you, and then there's another one that's arisen for Chris and Amit, so they can get ready as well. So the next question was, you mentioned looking at data to make decisions around what is working and what isn't working from a wellbeing perspective. Can you give some examples of this?
Yes. So the data is really great for making those informed decisions, and some of it will already be available. So there'll be a lot of sort of hard metric data that may be available, not necessarily available to tax to begin with, but within the finance and the HR functions, there should be the ability to extract some of this. So some examples are things like if you've had the introduction of apps, for example, app usage rate, what's been the take up there, outcomes from employee engagement surveys. A lot of organisations have started utilising or training up mental health champions. So is there data and insights that can be provided there? Obviously, taking into account that there will be a level of confidentiality, but are there themes in terms of what the workforce are wanting support on? That also aligns with employee feedback. And then you've got other things such as EAP utilisation and benefits utilisation more broadly, and linking that to things like sickness absence rates, which really can help strengthen the business case that you then have for introducing new benefits. Other things, again, that may be more industry specific, are whether you've got health and safety data, or if you've got employee resource groups or union groups that can share information. And that's where we really then start thinking about, you know, the more softer metrics. So workplace relations, thinking about things like retention figures as well. So there is a plethora out there, and what I'd recommend is thinking about, well, what's the hard metrics that are available, and what are the sort of softer data sets that are also available, and using those in tandem.
Thanks, Karen. Right, we'll switch to Chris, but I think we do have a few more employment taxes questions queued up, so we might come back to you as well. Okay, Chris, so question for you on AI. It's kind of multi-level question. Where are you seeing AI built into technology platforms? How close are we to AI being able to complete a whole corporation tax return, as an example? VAT returns are generally more straightforward. Is that perhaps more likely in the near future than for, say, CT?
Yeah, it's a good question. I suppose just first, Claire, as well, I was going to say I saw we had another question as well around the tech presentation. Just generally, I think someone said assumes a lot of prior knowledge. So it's more of a comment, which I think is a fair point. It's a bit of a complicated beast, tax technology. We could almost spend probably would bore you all to death. But we could spend a whole hour talking about tax technology. But yeah, happy to pick up on any more detail behind the scenes. But hopefully those examples that Amit gave on where we're seeing automation tools being used, for example, is useful. And then yeah, in terms of AI, so I think how we see it at the moment is more discrete use cases, to be honest, and more in terms of areas like capital allowances or R&D, where you're looking at classification and set decisions where you can have rules, but then you can build on machine learning on top of that to give you a confidence level on how accurate that classification is or might be, and so you can almost pinpoint where you spend your time to review, rather than reviewing a massive amount of data. You can pinpoint it to the key risk areas or areas which are too uncertain to decide based on for a machine, essentially. And then yeah, and then more on the VAT side, so outside of the VAT return, we see it for, say, complex retailers. We've leveraged it quite a bit for product file reviews, where you've got a retailer with 40,000 different products, and it's kind of how do you make sure, or try and make sure, that the correct VAT rate has been applied to all those products. So again, using AI machine learning is another great way to quickly review all of those product lines, and again flag to you in real time which lines you might need to pay a bit more attention to, and where there could be more debate over that treatment. So it's more discrete at the moment, is how we see it. Hope that answers the question, Claire.
Thanks, Chris. Okay, if we switch back to Karen then for a couple of employment taxes questions. So the next question is, we've introduced a health cash plan this year, which incorporates an employee assistance program. We've payrolled it for employees, and it now shows on their payslip as a notional payment for calculating tax. We've then prepared the data to include on our P11D to pay the employer's NIC. Is that sufficient, or might the employer have a tax liability too?
Okay. Well, without ruining the party here, unfortunately, that will veer into tax advice. So this anonymous attendee, what I would suggest is please feel free to reach out to me, and I can pick up on answering the specifics. But in terms of the more general, this is a great point to be considering, because for those of you, again, who deal with employment taxes within the business, you will know that there is mandatory payrolling of benefits coming in a couple of years. So payrolling of benefits has been voluntary at the moment, and what that means is rather than having benefits reported on a P11D and the tax collected on the P11D, if the benefit can be payrolled, then this tax is collected via the payrolling. Now, what that's meant to do is alleviate the administration, so you don't payroll and also report on a P11D in this sort of circumstance. But from 2026, it's actually going to become mandatory. And so what that is doing is meaning that a lot of organisations are probably going to be coming up with a a question very similar to this in the foreseeable future. So if you don't already pay roll benefits and you are having to consider this, then this is something that you should be aligned to going forward. But for this specific attendee, as I said, happy if you reach out to me and share your details. I can take that offline.
That's great. Thank you, Karen. We've got one more generic question, which I'll happily pick up, which was, if we do have a new government and they look to raise one of the taxes, income tax, VAT, corporation tax, what would that do in terms of overall tax revenues generated? So I think what this is getting at is, where should the new government place their bets? Which one will be the biggest earner, and how does that compare to other taxes? So really high level, broad brush in terms of response. If coming from a CT background, if the government, whoever that may be, were to increase the rate of corporation tax by just 1%, broadly speaking, you'd expect that to bring in around 4 billion of additional tax revenues. Now, in terms of how that compares, I think approximately that the split is that if you were instead to bring in a 1% rise in income tax, that would be more like 8 billion. So you're looking at double the benefit of increasing the CT rate. I'm not 100% sure on the VAT, but expectation is that if you were to increase VAT, and maybe Chris or Ramit could chip in, but by 1%, that would have an even bigger impact. So maybe if the influx for increasing the income tax rate was 8 billion, you'd be looking at more around the lines of sort of 10, 11 billion for VAT. So that would definitely be the biggest earner and corporation tax at the lower end of the spectrum. Right, so I think we're almost at time, so I'll call the questions there. If we can just flick on to the next slide, please. Just wanted to flag a couple of upcoming events and webinars. So tomorrow we have the first in our instalment of the Supply Chain Resilience series, focusing on the new carbon border adjustment mechanism. Then the slides disappeared there. I don't know if that's just for me or for everyone. We've also got a tax automation and innovation webinar on the 26th of June, which is focusing specifically on Pillar 2 for those larger businesses that are impacted. And throughout June, we host a number of tax and industry forum events out in the regions. Most of those are in person. If you want to find out if there's one in your region, then please do drop a note to Phil Ward, whose email address is on the screen there, and he can let you know if there is one in your area. And then finally, if we just flip to the last slide, just a reminder that you can sign up to our monthly On Top of Tax newsletter if you click the link when you receive the slides. And we also have an On Top of Tax group on LinkedIn where you can follow and also look out for updates there. Thank you very much for everyone for attending today, and hope to catch you at the next webinar in a few months' time. Thanks all.